Emerging markets are attracting more attention lately, especially China and Southeast Asia. What's the outlook for 2013? Analysts see continued opportunity in emerging markets, but not without risk.
Well, emerging markets is used to describe a bunch of countries at a certain stage of development in their economies as well as their capital markets. It usually includes like China, India, the countries in Latin America, the countries in Southeast Asia. One thing investors should keep in mind is that while these countries are likely to see stronger GDP growth, it doesn't necessarily translate into a strong stock market performance.
Well, I actually think it's a really exciting time to be talking about emerging market products. Obviously, we've had a lot going on around the globe, but if we look at many of the underlying secular trends that we follow closely, whether it be the wealth that's growing in different economies around the world, the population growth, there are so many factors that suggest on a long-term basis that it's going to be attractive to have exposure to emerging markets.
Two of the larger economies in the Southeast Asia is Indonesia and Malaysia. They've kind of underperformed the U.S. markets and developed markets in the last year, but actually since the 2008 financial crisis, they've actually done very, very well. Thailand's been an outlier. They've actually continued to outperform since the crisis. These countries have improved a lot since the Asian financial crisis, which was in the late 1990s. Banks are much healthier, the government's balance sheets are much healthier, the economies are much more transparent and open. So I think these are the reasons why the economies have been doing a lot better, and stock market has also done a lot better.
Of course, some emerging markets are more developed than others. Vietnam, for example, may have a bright future, but currently faces challenges.
Many things we have to learn from American business community, but in the future, we look forward to the future.
We consider Vietnam to be a frontier market, which is a below emerging market, so it means that their economies and their capital markets are actually less developed. But there has been investor interest in Vietnam. There are two positive trends there. One is that their population is relatively young, so that's positive. Number two is that in China, we're expecting to see wage growth pick up, and so manufacturers are likely going to diversify out of China, and Vietnam is expected to be a beneficiary of that trend.
Our labor force is the most important thing, and we try to keep it, try to make it become our competitive advantage to attract more and more foreign investors to our economy.
Wee says Vietnam may be too risky for many. She looks for broadly diversified funds with track records showing lower volatility. In December, we highlighted two ETFs in the emerging markets category.
The first is iShares, MSCI Emerging Markets Minimum Volatility. The ticker is EMV. This fund, it tracks an index, and what the index does is that it selects companies that exhibited the least volatility for the portfolio. And so actually, over the last 10 years, this index has outperformed its parent index by about 300 basis points annualized. So we definitely like this fund. Another fund we like is Emerging Global Shares Consumer. The ticker is ECON. What it does is that it invests in 30 of the largest consumer companies in emerging markets. And one of the most popular themes in emerging markets is the growing and rising middle class. So the companies in this fund, such as beverage companies, cigarette companies, they're most likely to benefit from this trend.
Emerging markets, Wee says investors with a 25% global equity allocation may want to consider devoting part of that, roughly 10% overall, to emerging markets. This is ETF Newsline. Thanks for watching.